This one fact about real estate has created generational wealth over the last 100 years, and everybody is ignoring it. We don't think you should.
Real estate market at rock bottom. Real estate bubble about to burst. Foreclosure skyrockets. Real estate market in jeopardy. Real estate bubble bursts. Real estate market crashes. These headlines are pretty stark. Well, what if I told you that these headlines aren't from 2023? In fact, the headlines are from as early as 1933 into the 70s, 90s, 2000s, the Great Recession, and 2020.
This may be a surprising fact for most of you, and so in this episode, we'll dive into statistical data so you can draw your own conclusion about what this really means without allowing talking heads like us to steer you one way or the other.
How can we use our newfound understanding of the housing market historical data to our financial advantage, and what pitfalls to avoid in the short term?
According to economic data from the St. Louis Fed, the U.S. median home price in 1933 was $3,900 and it was $17,800 in the 1960s. By 1971, it grew to $34,000. Fast forward to today, and we are now at $430,300.
Juxtapose this with the doomsday headlines from yesteryears, and one thing stands out extremely clearly: the housing market always perseveres. So if historical data paints a more stable picture of the housing market, what gives?
Why are the near-term hysteria? To understand this, let us tell you a short fable called The Blind Man and the Elephant.
A group of blind men, encountered an elephant for the first time and tried to learn about it by touching different parts of the animal. Each man feels a different part of the animal. One feels the trunk, one another the leg, another the tail, and so forth. As a result, they come to wildly different conclusions about what an elephant actually is.
The man who feels the trunk believes an elephant is like a snake. The one who touches the leg insists it's like a tree. The one who feels the tail says it's like a rope, and so on.
When they compare notes, they realize that their understanding is in complete disagreement. They started arguing and fighting, believing that he is correct and the other is wrong. The fable concludes with the moral that we may be blinded or ignorant like the blind men, and we might fail to see the whole truth or the whole reality, often leading us to misinterpretation and conflict.
This fable illustrates how people may get a skewed or incomplete picture of real estate market based on limited or selective information.
Much like the blind man in the story, investors might be focusing on one aspect of the market, like a downturn or a bubble. I believe it represents the entire picture. This narrow view can lead to misunderstanding, panic, and poor decision-making.
Encouraging a holistic approach and understanding of the market, considering both its challenge and opportunities, can provide a more accurate and empowering perspective for investors.
Now, we're not saying that where everything is Jolly Rancher with real estate. We definitely see short-term issues facing some investors.
No doubt we are in extremely high interest rate environment, but did you know that we are considered extremely spoiled by the baby boomers who were buying properties back in the 1980s?
According to the U.S. World and News Report, the mortgage rate hit its all-time high ever recorded at 18.60% in 1981. And we're here bemoaning over the 6, 7, or 8% interest rate we're facing today. Many people will say, hey, wait, but home prices are much higher today than they were back then. And you guess what? They're right. But do you realize that most real estate are on fixed rate loans? And most were purchased between March 2022 and the present.
For context, according to bankrate.com, over 70% of mortgages are on a 30 years fixed rate, 9% are on a 15-year fixed rate, and 1% is on a 5-year ARM or adjustable rate mortgage.
So why is everyone freaking about a real estate market crash then?
They do understand that unlike the stock market, real estate investors don't need to track the property's value daily, since it has zero impact on their rental returns, their tax depreciations, or their future value.
Because there's only 3 times when the property's value matters. The first time is when you buy, the second is when you refinance, and the third is when you sell. The market's temporary decline is only a blip on the graph that's shooting skyward.
Think about it like this. Oh, Amazon Prime Day.
Or on the enchanted siren calls of Amazon Prime Day and bonanza bargains that entices consumers with the irresistible allure of saving supposedly too good to ignore. Watch as sensible folks are lured and hypnotized by the flashing lights of unbelievable deals and once-in-a-lifetime deals. With every click, they're convinced that they outsmarted the system, snagged that treasure at a laughable price.
In every aspect of our lives, we love a great bargain. We even buy things we don't even need for the love of a good discount.
I mean, why else would I have bought the multi-blade scissors unless it's like 50% off? I mean, I don't even really cook. However, when it comes to real estate, we've become paralyzed by these super gloomy headlines, resisting the urge to swoop in and seize available bargains logically.
Here's the deal, guys. Everyone, while interest rates are higher than we would like, that doesn't necessarily matter.
If we meticulously factor in rates into our investment analysis, ensuring that we can easily cover expenses like mortgage, insurance, property taxes, etc., and still enjoy a healthy cash flow, then actually the cost of money becomes irrelevant.
Our anxiety over housing market crashes can be likened to the blind man who perceived only a portion of an elephant. Meanwhile, the undeniable truth is the U.S. faces a significant housing shortage.
The 2023 State of the Nation Housing Report by Habitat for Humanity indicates that there's a surge in homeownership costs in 2022, pushing 2.4 million Americans out of the market. This spike has led to unprecedented housing cost burdens.
With the supply of homes for sale scarce nearly at record lows, the home rental market is expected to stay strong.
Forbes report that the housing stock is alarmingly low, hitting near historical levels, with entry homes being especially scarce. The shortages keeps demand high and prices inflated. Adding to the predicament is recent weeks saw a decline in new home construction, which had previously alleviated some pressure. Jack McDowell, the chief investment officer and co-founder of Palace Groups, notes that the current inventory is about 46% beneath the historical average since 1999. He anticipates that resolving the inventory issue in 2023 is improbable.
In wrapping up today's episode, by now we hope we have helped you demystify and draw a clear line between unfounded fears and the realities of real estate investing.
While doomsday headlines may lead you to believe that the sky is falling, remember that reality is that real estate market has stood resilient against time, providing generational wealth, much like the steadfast elephant, unfazed by the surrounding chaos.
Economic cycles with their ebbs and flows are inevitable, but history shows us that real estate value tends to increase over long term.
Yes, though the current high interest rates are real, they should be navigated with strategic thinking rather than fear. With meticulous planning and analysis, it's entirely feasible to secure investments that not only cover your costs, but also provide a healthy cash flow, even in today's market.
So when gloomy headlines try to sow doubt, remember to take a step back, look at the whole elephant, and invest wisely with a long-term perspective.
Now that you've discovered the biggest lie you've been told about real estate, watch this video to learn why the destruction of the US dollar is good for real estate.